So before the break, David transported us back to 1896. My opening story is from a slightly more recent past, but I'd like to transport you to 2005, where I had just left being a borrower, joined a bank, went to credit committee for the very first time, wrote a credit paper, got to credit committee and was told that this is very much a sell paper and not a tell paper, and that I was going to need to rewrite it before I would get my approval, and I was going to have to rewrite it warts and all. And I think that this presentation of warts and all is a very important factor in terms of ECA funding, and I'm going to come to this theme a number of times in explaining what there is need for ECA funding, what we do, and how you can actually access this capital. So I think that the first thing that I should talk about is the motivation of the ECAs. And simply put, it's the same as what's motivated them for 100 years, and that is jobs. The whole purpose of an ECA is to make sure that the manufacturing jobs within that country are maintained and kept there and not outsourced to a cheaper labor environment. That is what they are there for. And if you think about that fact every single time you're approaching an ECA, your life will be so much easier in your approach than thinking about them entirely in a transactional way of, this is a really good deal and it has this security and this is the pay down and this is our cash flow and all the rest of it. The one key additional factor when you're approaching an ECA has to be their motivation to maintain jobs in their country. And if you maintain that mentality, your lives will be easier. And we can obviously help you do that, but that's advertising that Alistair asked me not to do. So with that in mind, I'd like to go on to talk about how commercial debt differs from ECA debt. And fundamentally, it doesn't. Apart from this motivation, this additional factor, when you approach an ECA, you are approaching it for what is going to look in the long term like commercial debt. You have a bank, you have a credit committee, you have a set of rules and regulations by which the bank can operate, and its job is to help you pay for that helicopter so that it can function in the way that you want it to function. So it's going to go through an ordinary due diligence and KYC and anti-money laundering process. You're going to present broadly the same information to the ECA as you would present to any normal bank. You'll receive a term sheet from the bank that will be pretty much identical to what you will receive from a commercial lender. And your documentation will, by and large, be the same as what you would receive from a commercial lender. The one difference being that instead of paying the margin entirely to the bank at a much higher rate, traditionally ECA margins are a lot lower, but you have a fee that is paid to the export credit agency, which you borrow and repay over time. And in a perfect world, these two things should be, by and large, the same. So with that in mind, you may be asking the question, why do the ECAs exist at all if all they do is pretty much replicate what the commercial lenders do? And we had a panel of 5 or 6 commercial lenders here this morning, and they were all battling it out to explain what they offered to the market. And the key reason that ECAs still exist and are very active in this environment is twofold. Firstly, they will operate in cycles that commercial lenders tend to run for the hills. They have been around for over 100 years. I think UK Export Credit, under various different names, but have claimed to be the oldest in the world, and they're over 100 years old now. They've been through every up cycle and every down cycle, and they're there to support in the down as well as the up. The second is that they are much, much more open, particularly to more exotic jurisdictions. So in our current guys at AirFinance, we have been around for about 15 years, just under 15 years now. We have provided debt into West Africa, East Africa, Southeast Asia, South America, all over the world, into some very, very difficult jurisdictions, difficult legal environments. And what we are there to do is help the manufacturers sell into slightly more difficult environments so that these are net additive sales in a way that commercial lenders are simply just not set up to do. It's not their role to be helping manufacturers to sell into really, really difficult environments. That's not going to get blessing from any credit committee in the world. And so in terms of thinking about where ECAs really come into their own is thinking about where potentially the holes in the market might be already. So if you think about the panel this morning, there is a lot of debt that's going in primarily to lessor environments. It's less so directly to the operators. I know it's not none before everyone complains at me. I know it's not none, but it is primarily to the lessors who then lease the aircraft onto their customer base. Our role over the last 15 years has been entirely with end users, and as we all know, most end users want a balance between leased assets and owned assets. And what we have experienced is a lot of those operators have come to us and said, for the leased assets that we take, we are flooded with offers. It's all good. We don't need your help. Thanks very much, but no thanks. But as soon as we want to buy one on our own balance sheet, we can't find a lender because we're in Brazil or Mexico or Ivory Coast or Tanzania. Those are environments that we help, we fulfill, and we've been very successful at making sure that the transactions get through the ECAs and therefore are able to fill those gaps in the market and making sure that the manufacturers have a much wider breadth of potential sales environments compared with just those that the debt providers are prepared to do or the lessors are prepared to do. So with that in mind, the other gap in the market that was brought up immediately before this presentation and before the tea that we just had is new types. Traditionally, it's been very difficult to get that first deal either with a lessor or with a debt provider on a new type because this is a very highly technical asset class. The lenders in this environment are not just cowboys who are here, with no technical knowledge. They're actually primarily industry professionals, and they are very focused on, what's the history of this aircraft type? What's my residual going to look like? What's my LTV going to look like throughout the term? And it's very difficult for the manufacturers to get those first few serial numbers funded with those lenders because, for obvious reasons, the historic data isn't there. ECAs, on the other hand, love the fact that the manufacturers are making new product. They're making them in a particular country, and that's benefiting the jobs within that country, coming back to this idea of jobs, which motivates all ECAs. And so if you are Bell manufacturing in Tennessee, then you are much more likely to get the support of Exim Bank, knowing that they have selected the US to manufacture this product. They could have gone to Canada. They could have gone to Mexico. They could have gone to Poland. The expertise is there in all of those countries, but the fact that those jobs have gone to the US market means that qualifies for Exim support, and because it qualifies for Exim support, Exim are very keen to make sure that it's known in the market that support is available for the right clients and the right client base. So that leads me to kind of the last point that I was asked to address, which is what the ECAs are looking for in order to qualify for their debt. And in that sense, they are quite traditional lenders. They're looking for a counterparty. This is not asset-only recourse. It is a recourse debt, so they are looking for a counterparty that they can go to committee and say, we're lending against this counterparty for the following reasons. We have 3 years' worth of audited financial statements. We have reasonable belief to believe that they have the ability to repay, whether that's a contract attached or whether it's the financials of the company themselves. They're looking for a reason why they are needed. And this comes back to my original story about presenting warts and all. There is nothing wrong with presenting to an ECA and saying, the reason that I cannot get debt is because X, Y, and Z. This is the problem with my deal. This is why I'm not getting it away in the commercial market. Now, that might be as simple as I'm in Tanzania and nobody wants to fund an aircraft in Tanzania right now. That's fine, no problem. That might be I operate in an environment that that is particularly aggressive towards the wear and tear of the helicopter, and therefore the debt lenders don't want to be in that environment, and therefore I need ECA debt because I don't have any other option. It is primarily there to solve those problems, and if you try to hide those problems or promote, as I did in my sell paper, not my tell paper, if you try to hide away from those problems, in fact, you might be doing yourself a real disservice, because the ECA might say, this is the sort of deal that should be getting away in the commercial market. So why am I here is a really, really key question for an ECA. And not only that, but there is no better story than the ECA saying, I received a call from the manufacturer thanking us because we wouldn't have got that sale without you. That is the sort of story that you want to be telling to an ECA, not hiding it away and saying this deal's perfect, you know, I've got everything right, because then they're going to be running for the hills saying this is the sort of deal that should be done by the commercial market. It's in a good jurisdiction, it's got cash flows attached, all the good stuff we heard earlier. So be very careful about trying to present your case to us or to anybody else or to any ECA, saying it's all perfect, saying everything's great, when actually what might be the thing that's required is the motivation to the ECA. And then the last thing that I would recommend in terms of securing ECA debt, in terms of what they're looking for, is if you go hand in hand with your manufacturer. Again, I come back to what motivates an ECA. What motivates an ECA is the jobs that the manufacturer holds. And so if you're going hand in hand with your manufacturer saying, here is a deal, here are the positives, here's why we can't get it away in the commercial market, and this manufacturer is standing alongside me saying this is a deal that they're very supportive of, you're much more likely to get the support of that ECA than you are if you just go alone or with a bank. You really do need that third party, that support of your manufacturer saying this is an important deal for us, it's an important deal for the jobs that we maintain in this country. And by doing that, you will be able to best your chances or improve your chances of getting that support and moving through the process quicker. And with that, you know, I'm happy to take any questions about this this part of the industry, this part of the debt industry. We've been doing it a long time. Happy to talk either directly or after the event, but please address any questions you have.
Andrew, thank you.
Pleasure.
You mentioned the ECAs were celebrating their centenary.
Yes.
Will they be more or less popular by 2030, and why?
No, it's interesting. I think a lot will depend on the wider economic environment. I don't think they're going anywhere. The biggest attack on any ECA has been Exim Bank. Exim Bank was attacked primarily by the Republican Party because it was seen, particularly around its relationship with Boeing, as preferential debt, and the US operators were very concerned about that. But that issue has gone away. Will they be more or less needed? Will largely depend on the panel that was up this morning. Mm-hmm. They will always be needed. There will always be deals that sit outside any commercial debt that is available. I just, with the greatest will in the world, no matter how competitive it gets, I used to work for RBS, so I mean, I know the NatWest team pretty well, and with the best will in the world, I just don't see RBS going into Ivory Coast anytime soon. And so because of that, I think that they're always going to be active. Whether they're more active depends on the economic winds. As the economic winds get stronger and against, they're going to be more active. And as they become easier, they're going to be less active. So it's going to be cyclical. And I wouldn't like to predict, but with the way that we've seen the tariff war, a tariff is basically the opposite of an ECA, right? So if you think about, if we're moving into a very tariff-high environment, then it kind of, the counter to that is actually how do we help exports? That's a way of protecting our manufacturers against imports. How do we help our exporters get the goods out? Well, if you're a high manufacturing country, then an ECA is a good way of supporting that. So if we're going into a high tariff environment, perhaps the counter to that is a much more active ECA market as well.
Okay. Andrew Woolfson, AirFinance, thank you so much.
Pleasure.